ahead of time and hoping to maintain it as hang on to it as the option goes towards expiration, right? So instead of buying and hoping that the option is worth more, we're actually selling and hoping the option is worth less at some point in the future. And the primary way to do that is, well, certainly we could just sell an option outright, but obviously, if you don't have that type of option trading ability in your account, or if you don't have that risk tolerance, that might be a strategy you might look to avoid. Selling options here in this scenario, we're talking about covered calls and cash secured puts. These are the ways to do it without, there's always going to be some element of risk, but keep in mind, just selling a straight call is the riskiest position you could possibly have as an option trader. Whereas selling covered calls, you mitigate that because we're actually owning the underlying. So let's take a look at that strategy first. Let's just kind of walk through what a covered call strategy looks like. So in this scenario, we'll take a look at a simple diagram here, and we're going to talk about a covered call. We're long 100 shares at $98 and we're short the 100 call at 350. So in this scenario, what are we trying to do here, right? Our outlook mainly is slightly bullish. I'm going to change that not to bullish, but slightly bullish to neutral. Why do I say slightly bullish? Well, we owned it at 98, right? And we're selling the 100 call. Well, honestly, we don't really want to go much beyond 100. In fact, our perfect scenario is this thing goes and expires at expiration, the underlying is at 100, so that that option is worth exactly zero, and we don't lose our stock, right? So that's one of the things we have to consider when we start doing a cover call strategy. We'll get into that a little bit later. But again, slightly bullish to neutral is really the strategy. This is not, in my book, I'd like to change that. It's not a bullish strategy, right? We're not looking for the stock to go up much higher. If we're looking for the stock to go much higher, then this might not be the right choice, or we might have to choose a different strike price if that's the case with regards to our covered call. So the construction is quite straightforward. We bought or we own the stock itself, and we sold a call option on a share for share basis. What does that mean? That means that in this scenario, we're long 100 shares at 98 and we sold one call. So one call covers 100 shares. So if we had 160 shares, we could still only do one call. But if we had 300 shares, well, then we could sell three calls if we wanted to. So again, call a share for share basis, making sure that what we are selling actually corresponds to what we are currently holding at this point. The max gain is going to be that strike price plus that call premium received less the cost of the long shares. So in other words, if we were to take a look at this scenario right here, if we're long that 100 shares at 98 and we sell those calls at $3.50, our goal is to maintain at that 350, right? And again, the perfect scenario is it goes to 100, we'd actually make $2 on our shares and keep the 350 that we got for selling that particular premium. If the stock stayed right where it's at $98, well, we'd still be $3.50 to the good side if it did expire at that level. So again, the max gain is what we're hoping to hang on to with that call premium. The max loss, it could be substantial, right? Because why do we have, as far as exposure is concerned? Well, think about this. If we start to go the opposite direction, right, that covered call isn't going to do us any good. Yes, we'll be able to keep that $3.50 premium, but the stock could technically go to zero, right? And if it does go to zero, then we've got a pretty substantial loss on our hands. So again, we still have the exposure of those long shares, but the covered call that we have is certainly not going to help us on the downside. So again, that is going to be a risk maintaining this position. We're hoping that it doesn't go substantially lower. We'd like it to stay where it's at or maybe slightly higher. And we certainly hope that it doesn't go too high because we don't necessarily want to lose the stock itself. Now, that being said, there are certainly strategies and there are certainly people who trade a covered call for the hopes of losing their stock. But I'm going to assume in most scenarios that you're not looking to do that. We're just looking to generate some income on our holdings that we currently have at this point. So the break even and expiration is that stock price minus the call premium received. So again, if we're long from 98 and we bring in $3.50, well, that means we can subtract that from our price, right? So that brings us down to 94.50 would be our break even price. And as you can see right here, it's exactly what it's showing us on this chart. That 94.50 is where we're at the break even. So a lot of pieces here. Hopefully that makes sense. But again, this is essentially we're holding the stock itself. We're looking for a slightly bullish to neutral outlook. We're selling the call against it to generate that income. We're generating that $3.50. We're hoping to hang on to that as we proceed forward with the stock as we get closer to expiration. Ideally, it wouldn't go beyond the strike, maybe somewhere between where we currently own it and somewhere at the strike price itself. But again, we are exposing the downside because we are still long those 100 shares, and being short a call in a declining market isn't going to do us any good because we've brought in that premium, and of course, it's going to be worth zero if it continues to move lower. So that's a covered call. The other one I'll touch on, and I'll pass it to you, James, is the short put strategy. Now, this one again, excuse me, is this one could be considered more of a bullish transaction, bullish to neutral once again. But the idea here is that we are going to be selling a put and covering it with cash, right? In other words, what is the worst case scenario in this particular one, right? I'm going to pass it to you, James. I got a little bit of a tickle in my throat. I'll be right back.
Well, one thing when looking at this, first thing I always point out is how the P&L diagram, right, is right more or less the same, right? When you're comparing that covered call versus the short put, you can think of, well, hey, you're still to some extent putting on a very similar strategy. It's just one with stock and one without, still having that substantial downside kind of to the bottom. We still have the capped upside should price move upward. Now, unlike a kind of long call, when it comes to your or short call, a covered call, your maximum gain is going to be just your premium received. Unlike with the covered call, where there could be some additional gain re relative from the difference between the strike price and well, what your purchase price is. But both the short put and the covered call are really going to be I guess I would say, the lead income strategies for most options traders out there, because for quite a long time, they were considered one of the lower level, especially for those of you that have been with Fidelity for some time when there was five different trading levels, well, or five different options trading approval levels. Well, covered calls was the very first one, and it's a somewhat of a natural progression coming from the stock world. And it feels a lot less intimidating than some of the other also very heavily used income strategies such as credit spreads and short iron condors. If I were to think about the major income strategies over the past few years that I've seen traders use, it would be covered calls, probably first and foremost. Well, I take that back. Lately, it's been short puts, I think might have taken the crown here, but it's really gone back and forth between short puts and covered calls. Second, short iron condors, they've had their place in the past, and then credit spreads. Right? All strategies that are designed really to bring in income into an account, they all have that kind of capped gain. And that's really the way that I like to think of income strategies. You know the most amount of money that you're going to be able to gain from the trade because you take that in first and foremost. Unlike using options for leverage, where you're typically paying money first, and then you can see that profit. And to some extent, hey, you can buy options and create income, right? You sure. You buy an option at a lower price, sell it at a higher price, and you've created a profit, right? You can think of it, you've created income. But when it comes to these income strategies, they really are, right, cash being deposited into your account, right? Similar to what you may be used to when it comes to bonds and CDs, money markets, and dividend paying equities. And as we talk about these two strategies, keep in mind that if you're looking for fixed income, these are not the strategies for fixed income. This is not a fixed income kind of a supplement of fixed income in a diversified portfolio. Right? Bonds and CDs are what are designed to give you fixed income. There are money markets, right, as Albert mentioned, which do pay, right, to the levels that a lot of bonds and CDs pay, but can we really call money market fixed income? I really can't because it fluctuates, right? We don't know what it's going to be paying. So you can think of money markets, they're good for regular income. I mean, they're going to pay you income and it's going to be regular. You'll get that kind of once a month income, but it's not fixed. It fluctuates, unlike bonds and CDs that are fixed. So we've got, again, bonds and CDs that are fixed income. We've got money markets that are regular income. Dividend paying equities are somewhat regular and somewhat fixed. Typically, at least here in the US, companies are paying quarterly dividends, and for the most part, those dividends stay constant. Ideally, they rise, but things can occur. I think one that always kind of struck out was there've been a few companies here. I remember it was Royal Dutch Shell, RDSA, I think B, they've got multiple share classes nowadays. But that's an example of a company that back during COVID, quite a few companies pulled their dividend or cut their dividend. But that was the first time Shell had cut their dividend since World War II. So dividend paying equities, if you're again looking for regular income and somewhat fixed income, can again provide that. But when we're talking about these two strategies, short put and a covered call, well, that outlook, the fact that it's bullish neutral should let us know income strategies with options are neither fixed nor are they designed to be regular income. I like to view this as just a supplemental kind of strategy for income when the time is right. Far often, I've seen traders when they first discover covered calls and cash covered puts and using them together, creating oftentimes what's called the wheel strategy, which is just a fancy way of saying they're doing one and the other constantly. Well, think of everyone. Is a stock always bullish and neutral? Well, no, right? It's not always going to be either bullish or neutral. Stocks go through periods of downturns. So traders that think that these two strategies are going to be good for regular income or fixed income are going to be unfortunately sadly mistaken. And the traders that do try to force this type of I guess we could say requirement on these strategies, again, regular and fixed income, are usually creating a drag on their account with underperformance, sometimes unknowingly. So I want you to think about that as we kind of go forward in these two strategies. And at least, as we spend the remainder of the session, make sure you have the proper kind of expectation with these, thinking of these as that kind of spot supplemental income when the time is right. So that's going to bring us kind of to now taking a little bit of a deeper dive into understanding kind of options pricing. And, Cliff, I saw your comment. What approach do you take to determine kind of how far the money do you go? You mentioned covered call, but that's going to be certainly applicable for cash covered puts. But we can talk a little bit about the strike selection and options pricing first. So when it comes to options pricing, right? We can think of it as being somewhat split between two categories, right? There are 6 factors that go into kind of the options pricing model. But that final premium price, we can sometimes divide it between intrinsic value and time value. Now, intrinsic value is just any of the in the money amount of an option. We can find that for calls by taking the stock price minus the strike price. And for puts, we can take the strike price minus the stock price. So what that means is that the stock price is above a strike, it's going to have intrinsic value for calls. If a stock price is below the strike, it's going to have intrinsic value for puts. So it has to be positive. It's a negative number when you're doing this calculation, right? It's not going to have intrinsic value because we shouldn't be getting right a negative number when we're calculating this value. So that's all it is. The intrinsic money is just the in the money amount. Now, what traders of income are looking for is to capitalize on the time value. So that is for in the money options. Whatever else is the value there. After we've done our calculation to find out the intrinsic value, whatever the difference between the premium is and that intrinsic value. For true at the money and out of the money options, that's all there is time value. Now, when it comes to where do we find the most time value, we'll be talking about that later. But the most time value is going to be found at those at the money options. And as we go kind of further away from that at the money, both in and out of the money, the time value is going to kind of erode. Now, traders are looking to kind of find this balance between as much time value as they can possibly squeeze out of those options while keeping their risk as low as possible, right? If we had no risk and we could sell plenty of time value, we'd all be doing it and it wouldn't exist. So time value is ideally what you're looking to capitalize on. You can sell intrinsic value, but at that point, you're oftentimes now starting to take some type of directional speculation. Time is the one thing that we can count on to continue passing, right? We don't know if the stock is going to go up. Not going to go up. We don't know if it's going to go up or down. We can't really say for absolute certainty is volatility going to go up or down. We can speculate on it, but we don't know. What income traders are looking for is taking advantage of kind of the one thing we know, right? There's going to be a tomorrow. Whether we'll be here or not is another question, but there's going to be a tomorrow. So you're taking advantage of that assurance that time will pass. And as time passes, that value will decay, great, regardless of whether the stock goes up and down. Other factors are going to influence that option's price, but time will be decaying. So just a kind of a quick example here. How that intrinsic value. So if the stock is trading at 102, the call strike is at 100. We know there's $2 of intrinsic. And if that contract is $2.75, well, that extra 75 cents is going to be the time value. So the question now, what do you prefer? It's not really meant to be a right or a wrong answer, keeping in mind that to some extent, these strategies are really the same, right? They have almost the same kind of risk and reward characteristics, right? We still have the risk with a stock moving to the downside. We still have that capped reward. So the difference oftentimes is when someone's deciding whether they want to do a covered call or cash covered put is, do you already own the stock? We could create a covered call with pretty much the exact same risk reward as a cash covered put, depending on where we put our strike prices for those options. So understand that there shouldn't be anyone here saying a covered call is the best strategy out there, cash covered put's awful, or someone saying cash covered put's all you want to use, a covered call is awful. Just recognize that they're going to be very kind of similar strategies, just with or without the stock, and similar in the case of risk and reward. So, but I'll cover strike. I'll save the fun part of time for you here. So when it comes to now choosing your strike prices, because if you're in this session, we can talk about maybe in some of the demo portion finding underlyings, but quite frankly, a lot of folks already know what underlying that they are looking for. Not everyone, but oftentimes, at least when I've seen folks asking about these two strategies, they've already been kind of intrigued by a particular stock, and they're now looking to find what expiration and what strike. Really, the other two kind of aspects of that contract that you need to make a decision on after you've chosen the underlying. So, like with many things in life, we have to weigh a series of positives and negatives, trade-offs depending on whether we are going to be going in, out, or at the money. Now, about how all of these strategies are somewhat bullish to neutral outlooks. That doesn't mean very bullish, and that's a key term. We're saying bullish, but there is a bit of a spectrum of bullishness, right? If there's equal, neither bullish nor bearish, slightly bullish, slightly bearish, moderately bearish, very bullish, very bearish, maybe extremely bullish, extremely bearish, right? We're closer to that middle range here, not either in one direction or the other. Now, if we are, again, truly neutral, but somewhat concerned of a drop in price, and this is whether we're going to be doing a cash covered put um, or covered call, right? We want to then have our strike price to possibly be kind of at a lower level. Again, that's both for the covered call and the cash covered put. So what we've seen some traders do, if they're concerned about a small drop in price, well, they ideally want to lower their risk. So if you have that kind of concern with the price and you own the stock, ideally you still want to try to take in as much premium as possible, but you might even decide to sell slightly in the money buy. What this is doing is oftentimes not going to be the best scenario, but as long as you keep it somewhat in the money, you'll still be able to capture, ideally, plenty of time value, and you'll trade off some of that intrinsic value if the stock moves to the downside. Now, oftentimes, most traders aren't typically looking to sell deep in the money because if you're selling a deep in the money covered call, you're somewhat putting on a constructive sale at that point, right? You're selling enough intrinsic value that, well, you're going to lose in the stock and it's just going, and you're giving up some of the potential time value, which is what you are hoping to count on. But a slightly in the money buy right can be appropriate for those traders that are concerned about that small drop in price. But if you didn't own the stock, you could be looking at the out of the money cash covered put further down so that should the stock move slightly to the downside, you're not at risk of, in this case, having that put be assigned. Because again, your goal is to generate income as opposed to someone that could be selling a cash covered put looking to maybe get in at that lower price. Now, if you're completely neutral, which would be kind of an ideal scenario for a cash covered put and covered call, you're going to be looking at selling either at the money calls or at the money cash covered puts. Because if you're truly neutral, selling at those at the money options can give you the most amount of time value that exists out there. So with the passing of time, if it were to remain neutral, well, you're going to generate the highest amount of income, and especially right, you're thinking of yield, that allows you to maximize your yield on these strategies. Now, if you're slightly bullish, in this case, what you're going to want to do for the calls is give yourself some room for that stock price to appreciate, but still you want to give yourself some income. So you'll be selling that, out of the money call on your shares of stock. If you didn't own the stock, you could then be selling that in the money cash covered put. And it's always this kind of, I like to say, slightly in the money cash covered put. Whenever you're selling an option in the money, whether that be a call or a put, you need to make sure that you're still taking advantage of time value. You're still selling some amount of time value. That's where it can be helpful to maybe add that column on your options chain, time value. Because the moment you start selling too far in the money, you're starting to take on quite a lot of directional bias in your trade. And again, that's not what we're looking for if we're using options for income. Using options for income is for those traders out there that are trying to take advantage of that sideways action, right? There's other ways to get income. For the supplemental income, we're using these to take advantage of sideways movement. So hopefully that helps a little bit with when it comes to, strike selection. Again, you're looking for time value to be kind of enough to feel like you're being adequately compensated while not putting yourself in a position where you're taking too much of a directional bent, hence why you're going to be choosing the moneyness based on whether you're again that slightly bearish or concerned bearish, completely neutral, or slightly bullish. Shabbat, anything you wanted to further add on strike prices, or shall we get to the expiration selection?
Yeah, a couple of good things about this slide is that, it highlights, as you were saying, the idea that we're talking about using this for income. Now, there's obviously other ways to use these strategies. For example, you mentioned the wheel strategy, which is a very popular strategy. And what are they doing there? Well, they're simply starting, most of the time, they're starting by selling a cash covered put to get into the stock. In other words, they're anticipating or looking for that to actually get assigned to them and own the stock, and then they can turn around and sell the covered calls against it. So that's what a wheel strategy is. And that might be a different scenario for everybody, right? Maybe you're looking at you're doing your analysis, whether it be technical analysis or whatever, and you find a point on a chart where you think, hey, listen, if it gets here, I don't mind owning the stock, and that might be the strike you choose for your selection, right? At that point, that's a little bit different than income, right? Because now you're hoping to actually own the stock. So again, make sure that not just the scenarios that are laid out here on this particular slide, make sure it matches your objective as well, right? If you're looking simply to generate income, that might have a slightly different look than if you're actually trying to own the stock and then turn around and start writing covered calls on it. And that'll make a huge difference in what you're trying to do. I had a call just today with someone who was owning a stock and wanted to purchase more. And so he wanted to sell cash covered puts that were slightly in the money because he didn't know if the stock was going to back off enough for him to get more, be able to buy it at a level he wanted to buy it at. But by selling a slightly in the money cash covered put, he gave himself a better opportunity to maybe own that stock at expiration. So there are a variety of ways to go about it. Again, we're talking about income here. Just make sure that your strike selection matches your outlook with regards to what it is that you're trying to accomplish, whether it be income or owning a particular stock. One question I did see that I wanted to address from Ali, they were asking, why is a covered call strategy better than selling naked calls with a stop loss? Well, I'm not going to say that there's a better strategy, but let's remember what we're talking about here, right? We're talking about a covered call strategy, and if the covered call strategy, if you're analyzing it, what is your outlook? Your outlook is again that slightly bullish to neutral. If you're selling a naked call, that's a completely different outlook. You're probably bearish to neutral at that point, right? You're hoping the stock doesn't go up. So I wouldn't say better. I would say that those two strategies are completely different with outlooks and should be used for different types of outlooks. So definitely keep that straight when you're looking at those particular strategies. That being said, I'll go ahead and grab the screen from you, James, and we'll get to talking about the impact of a selection for expirations. And obviously, as we talked about previously, the idea of what goes into the price of an option, James touched on it earlier. There's 6 different elements. We could talk about the underlying price, of course, that strike selection, the interest rate, the implied volatility, the timed expiration, and potentially dividends. Now, I typically, dividends and interest rates, I kind of move them off to the side because not every stock pays a dividend, of course. And interest rates aren't really a tradable Greek for equities unless you're simply doing only long-term options. Then maybe you start to get into that. But really, when we talk about the 4 main ones, we're talking about the underlying, the strike selection, we're talking about the timed expiration, and then implied volatility. Now, intrinsic versus extrinsic. Intrinsic is made up of 2 things, 2 of those elements. That's just simply the underlying and the strike price, right? Is it in the money or out of the money, as James demonstrated earlier? The last part, that extrinsic value, that's made up of that timed expiration and an implied volatility. Well, that's going to be the part that we're looking at right now with regards to this expiration selection, because that's going to have a major impact, right? That timed expiration is going to be a huge difference with regards to which options we're choosing. So if we're talking about a shorter term, well, a common use here would, of course, be the maximize the annual rate of return and maintain flexibility. Well, what do you mean by that? Well, let's think of this scenario like in this example. Let's say that we have a stock that we own currently, and again, we can go back to the same example of $98 a share. And let's say that we want to maybe make sure that we're getting a good level to sell our covered call. We might sell, say, a 105 call that's maybe 30 days out to expiration. Maybe we get $2 for that particular option, for example. No, excuse me. Maybe we'll get like something like $3 for that particular option. And in any event, it's 30 days out. 30 days goes by, the stock moves up slightly, maybe moves up to about 100, but that option expires out of the money. We get to keep that $3, and now we get to do the same thing over again. Well, this time, maybe we don't want to sell, that 102 or 103 strike. Maybe we need to go out a little bit further because the stock has moved. Well, now we have that flexibility to sell a different strike and try to capture that same type of amount. Maybe we can do that over and over again over the course of the year and generate some better returns other than going with a longer dated type of option, right? We have the ability and the flexibility to change our strike price to stick with our idea of selling options, but not necessarily losing the stock itself. So that's what I think they're meaning by flexibility, of course, and maximizing the annual return. If we can do that over and over again over the course of a year, we've obviously increased our income there with regards to selling those strikes. Longer term, well, now we're really just kind of talking about targeting a specific annual rate of return, right? And we're more concerned about that income. We're saying to ourselves, look, maybe I could get more each month, but I just want to make sure I get this amount. And so therefore, I'm going to go out longer term and sell this particular option and bring in this particular income. Obviously, a lot can happen, right? And that's really probably one of the biggest issues, especially if we're talking about covered calls. I don't know about you, James, but when I was on the service desk, a lot of calls I would receive is, "Hey, listen, I've sold these covered calls, and now the stock actually went up further than I thought, and I don't want to lose it. What can I do?" And so part of the idea of choosing that expiration will hope to maybe alleviate that, right? In other words, we have that if we do shorter term, maybe we have the flexibility to adjust strikes month by month or every couple of months to make sure we don't lose that stock. But maybe on the longer term, if they're not concerned about losing the stock, then they might choose that longer term and lock in that annual rate of return. And again, prioritizing that income certainty over the appreciation of the stock itself. So again, make sure that first part is just to make sure it goes with the outlook that you have with regards to your position and ultimately what you hope to happen with that position. Premium, potential again for that higher annualized return, as we talked about before. If you can do the same thing over and over again each month, still bring in that $2 to $3, that might actually give you a higher annualized rate of return. Whereas the longer term, this is going to be the offer more upfront premium, right? So in other words, maybe if we're doing, say, that $3 option and we can do that 12 times, well, that's $36. Maybe if we go longer term, we can sell an option for $30, so slightly less, but we get that $30 up front and we have to mess with it every month. So again, you have to weigh that as to what it is you're trying to accomplish with regards to the premium. The risk, the risk here, and this is kind of the graph up in the top corner, which we can highlight, is that it offers the most exposure to time decay. Now, when we're talking about time expiration and time decay, the important part about that is that once we get to this, 30 to 60, 30 to 45 day window, that's really when that time decay really starts to pick up. And as you can see by this curve, right, it starts to really pick up. The at the money contract as well starts to really pick up in the last 30 days. And so that time to expiration, that acceleration of that time decay is going to happen in that type of window. So if we're using that shorter term, right, that's going to give us the most exposure to that time decay, the ability for that to kind of take that out of that particular option. Has the highest gamma risk, right? It's going to have the biggest change with regards to gamma and the delta of that option. As we get into deeper understanding of the Greeks, you'll see how that has an effect on that particular option. And of course, more commissions incurred. Obviously, if you're going to be doing the same thing over and over again over the course of 12 months, you will pay a little bit more as compared to doing it one time for a year. So that's a consideration to take in as well. On the longer term, right? Offers that more upfront downside protection. It's going to give us the ability to really lock in that premium ahead of time and not have to think about it going forward. Lower exposure to time decay. Obviously, as an option seller, you'd like to have that time decay, but again, the idea of having that return upfront and having that a specific annual rate of return might offset what you're trying to do with regards to that time decay. So you have to consider that as well. And of course, the opposite of the other one will have that lower gamma risk. I think really probably the thing that I would really harp on the most here is that when we talk about that rate of time decay, that's really going to be a big factor in this particular strategy, right? As an option seller, you're hoping that it decays, right? We're hoping that time goes by and the option goes to zero because that would give us our maximum return. We get to keep that entire premium. So obviously those shorter term options, those are going to have that faster rate of decay. As I said, in that 30 to 45 day time window is where it's really going to happen the most. And that theta is how we would talk about that options Greek, which is talking about that rate of time decay. As we get closer and closer to expiration, that theta increases, meaning that more and more of that option is going to, that value, that time value is going to fade away in that particular option. So these are the factors that we need to think about when we're thinking about expiration. Now, again, you might like the flexibility of having those shorter term options, knowing that you're going to have to pay maybe a little bit more in commission, but maybe that gives you the comfort knowing that you can adjust it maybe monthly or every other month or something along those lines, and be able to make sure that you're moving along your strikes with regards to the movement of the underlying and helping to maybe at least feel more comfortable about being able to maintain your actual position itself. And on the other hand, there are some people who are not concerned. Maybe you're not concerned with regards to losing the stock itself. Maybe you're hoping to, take in a particular amount for that position and knowing that at the end of the year, you made this much and maybe you'll lose the stock, maybe you won't. So you have to take those into consideration with regards to your outlook as well. So that's kind of the idea behind expiration selection. I'm sure I probably missed a few things. You might have anything to add here, James. I'd love to hear what your thoughts are.
Well, when it comes to expiration selection, this has oftentimes been a very kind of controversial topic because for probably a kind of a clear reason, the shorter term, at least initially, sounds like that's the way that you always want to go, right? It's the maximum, that's the highest potential, right? That you could have the highest rate of return. Or it's the most maximum rate of return as possible with shorter term options, right? If we take advantage of that steepest part of the time decay, right? Looking at the time to expiration, whether we're at the money or out of the money, well, if we could do that, say 30-day options 12 times, right, we're going to make more than doing one option 1 year into the future. But the odds of someone being right every single time, right, start to get a lot smaller. And one, years ago, I ran into a couple of clients who preferred to do longer dated options, upwards of, say, 6 months. I think even I've come across now I remember someone doing it 1 year. The reason why they liked going that far out, they understood that they're not taking in the kind of accelerated rate of time decay that someone with a shorter term option's doing. But what the longer term options have the benefit of is taking in that higher premium. Of course, right? You have that possible greater buffer if it starts turning around right where you get into that trade, getting more premium to get started with. But some folks just like the simplicity of when they're trying to calculate that annualized yield, right? If you're looking for, say, a such and such yield, well, you could go out 1 year. I'd say we're in January, you're looking out in December, and you think to yourself, okay, I wanted a 5% yield. How far down do I have to go? What strike price will give me that kind of 5% yield on the capital that I'm using as collateral, such as the stock or the cash that you have in the money market in the case of a cash covered put. And you could tell yourself, well, hey, I'm comfortable with that yield going one far out, and this strike price seems a little too high, or hey, that strike price, I could even go lower and still get the yield I'm looking for. Going out does have some extra benefits if some of you are looking for things from the simplicity sake. And we do have a kind of a fantastic tool that I think could be used to just remind folks. And again, what I think this session is going to be helpful for ideally, it's to just set those proper expectations. If we already know we can't expect regular and fixed income with options, we can't expect to be doing this strategy in every single market scenario for every single stock. It's just not going to be realistic. Well,
James,
we
one more
do
thought
have,
before we move on to
oh
the
yeah.
tool. Just I want to kind of a quick thought about a scenario that we could certainly think about, or anybody could think about, with regards to choosing that expiration. Think about NVIDIA, right? Think about if you had 100 shares of NVIDIA at the beginning of the year, and you decide you want to sell a covered call. Well, where would you have sold that, right? What strike would you have sold on that particular covered call? If you had maybe you sold it $50 out of the money at that point, you sold it a year out. Well, guess what? You're going to feel really terrible as we get towards the middle of the year, the end of the year, and you've missed out on so much upside appreciation on that particular stock, right? Yes, you sold it. Yes, you got money out of it, but you really gave up a lot for that particular option just to sell that option. And the only way to do anything about it is to buy it back, which is going to be extremely expensive to do at this point, right? So the only way you can combat that is by doing something shorter term. And maybe you write it at 50 and you don't get it you don't get called away the first month. Maybe you go out and it goes up and you write another one out, another 50 or 100, whatever it may be. But that is the one downside I would think about with covered calls. And it's certainly a call that I've taken plenty of times on the service side saying, I didn't think it was going to go up this much. I sold this covered call out a year because it was such a great premium. Now what do I do? So keep that in mind as well when you're choosing those expirations, that a lot can happen between now and a year from now. Maybe we have a bit more control in 30 days. You have to decide what's more important to you when you make those selections, but just kind of keep that in mind when you think about doing a covered call.
And Albert, I think NVIDIA might be a great example since you brought that up. Let's use that for our kind of hypothetical example. So if everyone here isn't familiar, right, with NVIDIA here, right, it's a stock that's gone up quite a bit over the past 1 year. Even if we go back further, looking at a 2-year time frame, right, it's gone up quite a bit. Knowing what we know now, would you say this was a neutral move, a bullish move, a very bullish move, or extremely bullish move, right? This is an extremely bullish move. Would covered calls have worked on this strategy? If you had sold calls, would you have made money? Well, you would have likely made money on the calls, but you would have been having a significant amount of opportunity cost where you wouldn't have made if you were letting yourself get assigned and then rebuying it, or if you were selling puts on this, right? Similar kind of both strategies, you would have underperformed NVIDIA to a significant margin, right? And we can see that on something like the Strategy Ideas tool. And what this tool is doing, it's just kind of running a back test for you to see what would have occurred. So the 2-year kind of annualized stock return, not the cumulative, what I just showed on the chart there, that kind of higher number, but it's been given at 147%. So we'll say 150% just to use a round number here. We're looking at covered calls. Sold 30 days out, either at, near, or out of the money. The criteria for that is looking at delta. So at the money is pretty self-explanatory, right? That's going to be whatever that kind of closest strike price is. Near the money, right? We're selling that a little further out of the money. So near the money is still out of the money. Out of the money, now you start to get even further out of the money. So in our examples, even if we were to do it at this case, this I think is a good example to show with NVIDIA at 1152. In this case, the at the money is 1170, so still higher. Near the money, 1230. Out of the money, 1300. So as you can see, they're going further and further as we look at our different time frames. And had you done that same at the money option, near the money or out of the money, 2 years, your returns would have significantly underperformed, right? Half of the performance of someone who just bought the stock. If I go 60 days, really is not much different, isn't it? 67, 80, 100, 180 days out, 63, 97, 104. Really not much difference on this stock. And we can see even the actual trade examples. If I click on view historical details, they're going to show us our trades down below. As you can see, there are these kind of red and green lines. They tell us whether we've made or lost money. So starting with the first one, 2 years ago, at this time, NVIDIA was somewhat flat. You would have sold the call, made $1,400. The next one, you would have made $1,200. The next you would have lost 2,000. This is assuming you would buy it back to close to keep those shares of stock. You would have lost 3,000, lost 3,000, lost 13,000. So in some sense, this is all the opportunity cost. This is for someone that didn't let themselves get assigned. Now, if you had, say, cash covered puts, I can click on covered calls, switch it to cash covered puts. We would have absolutely made money selling puts, right? We know going back as NVIDIA kept moving up, but 37%, 29.10. This is where that at the money continued to move upwards and going 60 or 180 days. We can see that the shorter term options did fairly well. And this is kind of an example where you really can't depend on this strategy to always be putting it on in your account. It's just not going to be the ideal strategies for someone that's looking for regular and fixed income. Waiting for those right opportunities, because there were times when NVIDIA was flat. But we can see on examples where a stock might have been kind of favorable for the strategy. I was looking at something like Intuit, and this stock still moved upwards. I'm going to show the percentage here in 2 years. I can get my clicker to work, trying to get as close to the 2-year time frame as possible. 60% now, 40%. So 40% in 2 years, right? Significantly less than what NVIDIA did. And this is a cumulative, not the annual. Noticing that it somewhat stayed flat relative to what it did later on. But we can see it was still kind of moved within this period of time for the first year. So what would this look like? What would Intuit look like? INTU. Let's look at cash covered puts. Well, let's start covered calls so we can get the base. And this is an example where with the stock annualized at 18%, the strategies did outperform it. And outperform is just letting us know, because ideally, if we're doing this trade, we almost need to outperform. If we're underperforming, then that means we're buying it back for more than what we're selling it for. So we're kind of, not only are we not generating income, we're kind of paying money to put on these strategies, so to speak, if we're underperforming what this says. And we can see by looking at 60 days, still outperformed, 180 days, still outperformed, not as much, right? Not as much. We didn't get to take advantage of that accelerator of time decay, but we still made income. Just going to go down to 60 days near the money. And here again, we can see we got 1,300, 1,100, 1,400, 1,500, 1,100, 780. So this is a 2-month profit that someone is generating. And notice on the upside move, they had to buy it back, but 898, right? 579. So it still wasn't as kind of large as the profits that we were making in the beginning. And we can even see this from a performance chart with the lighter gray line being the strategy performance. This is possibly assuming, right, you're not just taking out that money. If I switch this over to cash covered puts, remembering 18%, we're more or less kind of in line. 20, 17, 18. If I go to 60 days, we're starting to underperform if we went further out of the money. Near the money still outperformed no matter the time frame. And also what this doesn't include is right now that cash does pay something. You'd have your money in that cash covered put earning an additional yield. So we could even say, hey, all of what's showing here should actually be a little bit higher because we're going to be earning money on our cash. So reason why this tool was helpful, it was just meant to kind of highlight the benefits of being kind of tactical, or whatever, tactful, but not tactical, but it's being kind of, I guess we could say, particular with when you're putting on these trades, right? Moving in when the time is right, when the forecast is right, generate that extra income and be happy that you got that supplemental income, but not be relying on something like this each and every time. Now, so Cliff, hopefully that answered your question about thinking about how far out do we go, knowing that right there's positives and negatives. And as we saw these two different stocks, there wasn't necessarily one that was always doing better versus the other. Right? Just knowing that shorter term time frames, yes, you can get that higher yield, but if things start going wrong, it's a negative stock. Alibaba, for some reason, comes to my mind here. Um, we go to covered calls, right? It returned 8%. In this case, we can see different time frames, different expirations, how they had very different results. Even a shorter term with the strike prices at the money, but longer term was able to actually make money in a covered call. At the money, short-term options lost money again. So it's not always that this cut and dry scenario where, okay, shorter term options are going to be the best, right? Going out can be beneficial if the stock moves down, ideally in a not too drastic fashion. In this case, annualizing down 9%, selling near them at the money. So taking in the most amount of time value possible. So another question that came in was what do we think about selling covered calls on high implied volatility stocks? So when it comes to kind of selling options, ideally, right, we want to get as much juice from those options as possible. Juice meaning premium. I like to think of juice as kind of the time value that you can squeeze out of an option here. And higher implied volatility securities, the higher the IV, the greater the time value that they have. So selling stocks with higher IVs can, yes, theoretically give you higher return, but just remember that is also kind of accompanied by the higher risk involved as well, right? It has that higher IV to compensate you for that higher risk. So you gave a few of those kind of stocks that have significantly high levels of IV, right? There is a point where implied volatility could possibly be viewed as being too high. You might want to say, okay, this is too much volatility. I don't want to touch this with a 10-foot pole. But looking at the range of volatility, right? We have this in our option statistic tool where you can see that percentile, right? That 52-week range. Right? We could say it's better to sell it when IV is relatively higher than when it is relatively lower, relative in the scale that it typically exhibits. And this is a tool here. Now we have sessions where we spend a lot more time on this tool, but what I like about this is it somewhat shows an example, whether you're looking at some um, strategies, in this case, cash covered puts and covered call strategies. Clicking on cash covered puts, what this tool is designed to do is look for high yields on out of the money puts. And how do they achieve that? What they're looking for in this case is a high yield to strike. So you're taking in high premium relative to what that strike is. So in this case, just picking this top one here, strike price is 37, and we're getting paid $4 on that 37 to expire in roughly 1 month. So that's where that kind of yield to strike comes from, roughly an 11.5%. So some traders are going to look at this, but what do you notice with IV of all of these stocks? Now, some of you might even recognize a few of these stocks on this list. Look at these IVs. Very, very high. So are you comfortable with taking a position on a stock with a high IV? Now, what is crucial, right? We need to look at the charts. Let me pick this second one here, right? BYND. Are you bullish or neutral, right? Slightly bullish to neutral on whatever stock that you are looking at? Well, that is going to be up to kind of the trader here. We don't want necessarily high upward move or high downward move, but remembering that the volatility, and this is a lower price security here, just as an example, right? These are significant movements, right? These are 100% movements that has occurred, right? Going from close to around $5, right? Upwards of $10. So this is a significant move. Don't let the maybe lower price in this case fool you, which is what you'll oftentimes see lower price securities up on this list. And just switching to covered call, just so you could see this example, it scans for another kind of attribute, still trying to generate premium, but in this case, high implied volatility relative to recent historical volatility. And Cliff, one of the stocks that you gave me is on this list, as you can imagine. How are we sorting this in this case? The standstill return, looking at implied volatility, more so the call IV bid relative to the historical volatility. So higher volatility than what it has been and has exhibited prior. So volatility, you absolutely want to be paying attention to this, but make sure that, right, you are not falling victim to possibly the allure of a lot of juice, because right, everything is going to be kind of in balance here and there's trade-offs. Sure, you can make more, but that perceived risk is also going to be there. I saw that question, is this tool available to all Fidelity customers? If you were wondering about the backtesting tool, yes, this is available to all Fidelity customers within Active Trader Pro. You can download it there and you can view this strategy ideas. Now, this is backtesting, right? It's not trying to predict what's going to happen in the future, but I imagine it was still helpful when understanding the kind of expectations of you can't always place these strategies, because some stocks you're going to be hurting yourself more than helping yourself. The option statistics is the kind of range that you're going to see, or percentile. Are we low with BABA, right? We're relatively low. Something like the S&P 500, we're again on the kind of lower end. Mark, saw your comment. At what value does IV start to become a concern? So implied volatility, right? It's that representation of supply and demand. But what it also is, right? It's that one standard deviation, 1 year expected range of the underlying. So let's think of it this way. What do we know about the average kind of stock market return in a year, right? Typically the S&P is around, say, right, 10%. Some will say 7 to 10%, depending on how far back you go. Stocks can move significantly more, of course. Let's take a look at NVIDIA here. So if you saw a stock with 100% IV, so you're saying there's a 68% chance that the stock could move 100% up or down, 100% up, we'll even say, right? That's pretty high. So an IV, when you start to get over 100, is high. You could say, hey, an IV over 50 is starting to get high. But remember, it's all relative to the underlying. Broad market indices like the S&P 500, like the NASDAQ, right, looking at 11, 12, are going to be much lower than even well-established stocks, right, like Apple, like Amazon, paying attention here in the 24s. So typically, right, if you're looking for some of these tech stocks, the more well-established ones are going to be 20 or 30. You're looking at some of these kind of high flyers in the 40s and 50s. You start getting over that 60s and 70s, well, 70% move in 1 year, right? That's volatile. 100, 200%. Okay, now we're looking at these kind of astronomically high implied volatility levels. So Mark, hopefully that helps. But spend some time looking at IV at some of the stocks that you own, and you'll start to you'll start to see the relationship between kind of what's normal for maybe a stock or a group of stocks, a sector or an industry, and what is really something that you see only once in a possibly year, or maybe even once in a decade, with what we've seen with some of these stocks over the past couple of years. But I know we're already a few minutes over, so hopefully this session not only informed you of some ways that you can use options for income, but ideally set the proper expectations for using these strategies in the future and helping you in assistance with choosing that strike and expiration. We do have quite a few other sessions on the docket, so hopefully you'll join us in some of those other sessions. But until next time, everyone, please be safe out there. Best of luck on those option strategies, those income strategies that I think many of you might be continuing to place. And until next time, have a great rest of the day. Thank you, Albert, as always.